possessed by Marcus Garvey, the vessel, the body, ancestors inside me. I'm starting the insurrection. The Pope's blessings upon me couldn't even call me protection. Come for prayers, my question, why they tried to play us, I'm guessing. It's cause I call fundamentals, they might offend you. And when I wore my fatigues, what I got into. On the corner, had power, was a trapper shorty making plays every hour. I did it for the glory.
All right, peace, power, and profit. This is your neighborhood licensed financial advisor, Chris Woods. Today, we're going to discuss BDCs, private credit, and fsoc, and how all of this is tying in currently in the economic situation that we're in, and what possibly could happen if this dark market is not corrected, which, let's be honest, it's not going to be corrected, and it's already starting to crack or break open now. So anyway, BDCs. What are BDCs? So BDCs are business development companies. So it's a publicly traded investment firm that lends money to small and mid-sized private companies. Think of them as Wall Street lenders for companies that can't easily access banks or public markets. BDCs were created by the U.S. Congress in 1980 through amendments to the Investment Company Act of 1940, amendments creating BDCs. Their goal was to fund growing businesses that traditional banks avoided. How BDCs actually work. 1. Investors buy shares in a BDC just like a stock. Examples include Ares Capital Corporation, Main Street Capital Corporation, FSKKR Capital Corp. 2. The BDC pools investor money. 3. That capital is loaned to private companies. 4. Those companies pay high interest rates. 5. BDCs distribute most of that income back to investors as dividends. Important rule: BDCs must distribute 90% of taxable income to maintain pass-through tax treatment. So kind of like REITs or real estate investment trusts, also REPs, which is real estate limited partnerships, they have this same criteria when it comes to investing into these type of business structure. All right, moving on. So that's why many BDCs pay 8 to 12% plus dividend yields. All right, so where does private credit come in this whole ordeal? So private credit equals loans made outside the traditional banking system. Instead of banks lending money, it's now private funds, hedge funds, institutional investors, and BDCs. BDCs are one of the largest retail accessible vehicles for private credit exposure. So when you invest in a BDC, you're essentially investing in private corporate loans. So why private credit is exploding? Well, after the 2008 global financial crisis, regulations like Dodd-Frank Wall Street reform and the Consumer Protection Act forced banks to reduce risky lending. So who stepped in? Private credit funds, BDCs, private equity lenders. The result? Private credit has grown to over $1.7 trillion globally. Why companies borrow from BDCs? Companies use BDC loans for acquisitions, expansion, recapitalizations, refinancing debt. But the trade-off, interest rates are higher than bank loans. Typical range is between 8 and 14% interest. Why investors love BDCs? 3 big reasons. 1, high yield. Many BDCs pay 8 to 12% dividends. 2, access to private markets. Most investors can't invest directly in private credit funds. BDCs open that door. 3, floating rate loans. Many loans adjust with interest rates, so when rates rise, income rises too. The risk, important for credibility, BDCs aren't risk-free. Economic downturns equal more loan defaults. Illiquidity, underlying assets, higher leverage than traditional funds. If borrowers fail, dividends can drop. Simple way to explain this: banks pulled back after 2008, so a new trillion-dollar industry stepped in. Business development companies, or BDCs, are now lending billions to private companies, and investors are collecting the interest. Now, who's supposed to be overseeing this systemic risk if, that happens, which already is? So there was a entity that was created after the 2008 global financial crisis called fsoc. And so fsoc stands for Financial Stability Oversight Council. So it was created after the 2008 global financial crisis through the Dodd-Frank Wall Street reform and the Consumer Protection Act in 2010. Lawmakers realized something important: banks weren't the only institutions capable of crashing the financial system. So they created fsoc to monitor systemic risk across the entire financial market, including hedge funds, private credit, insurance companies, shadow banking, and fintechs. So who runs fsoc? The council is chaired by the U.S. Department of the Treasury and led by the Treasury Secretary. It includes the heads of major regulators like the Federal Reserve, Securities and Exchange Commission, or AKA the SEC, FDIC, which is Federal Deposit Insurance Corporation, the Commodity Futures Trading Commission, which is a CFTC, and the CFPB, which is the Consumer Financial Protection Bureau. So it's basically all the major financial regulators sitting at the same table. What fsoc actually does: 1, it monitors systemic risk. They watch for threats that could destabilize the financial financial system. Examples: excessive leverage, shadow banking growth, liquidity crisis, private credit, credit expansion. 2. Labels firms systemically important. FSOC can designate firms as SIFIs, or systemically important financial institutions. This means if this company fails, it could threaten the entire financial system. Those firms then face stricter regulation and capital requirements from the Federal Reserve. 3. Monitors the shadow banking system. This includes private credit funds, BDCs, hedge funds, money market funds, and fintech lenders. This is where your BDC/private credit content connects directly. Why FSOC is talking about private credit now. Private credit has exploded to 1.7+ trillion globally. Regulators worry that loans are illiquid, leverage is rising, many loans are floating rate, defaults could spike in a recession. So FSOC has been increasingly warning about risk in non-bank lending markets. That includes BDCs and private credit funds. I want to thank you for listening to this video. We'll catch you on the next one. I grant you all peace, power, and profit, and we see you next time.
Static selector.
Right. Yeah. Check it out. Now I won't turn the other cheek or walk away anytime it's beef. If it's stat, it'll be your last shuffle, I guarantee. I took a 40 course of casualties, I'm all ready. I studied 33 strategies, so bite the bullet. It's 2, 2, 3s through your cavities that exit out the back of your mullet. Should've happened to pull this trigger. So how you figure, nigga? I read the evidence and watched my sins off in the same.